Hey out there, welcome to the Kevin Strong Show. In this video, we're going to talk about Warren Buffett, the Oracle. He has $190 billion on the sideline waiting to deploy it because he's waiting for better prices. That's my opinion. We're going to talk about that. And there's also some recommendations in this article. I'm going to share with you 4 strategies that you can look at putting your cash to work for you if you don't want to put it in the stock market because that's just too risky of an appetite for you. And finally, the last half of the video, I'm going to show you a stock market chart, a historical stock market chart, like 100 years. And I'm going to show you what happens when you buy something at the top and how long it takes you to get your money back when it starts to significantly go down in value. So if you're new to the program, welcome. My name is Kevin Strong. I'm your host. Consider hitting that like button and subscribing. So without further ado, we're going to go ahead and slide over and look at this Warren Buffett article. And as I said earlier at the beginning here, Warren has 190, it says 189. I just rounded this up, guys. $189 billion he's got set up on the sideline. The most money Berkshire Hathaway has ever had set up in a cash reserve ever in its history. So something big is going to happen. 2 noteworthy things has happened recently to the company. They sold at a substantial loss a lot of shares from Paramount Global. And some of you may be aware that he sold 116 million shares of Apple stock. But the article clearly says that he remains bullish on the stock long term. But right now, I guess he figures he's better off just being in cash. As a side note, you know what's kind of funny? I was thinking about this. You know me, I got to bring a little humor in this to lighten it up. You hear all this dating stuff, right? And women are famous for saying, you know, he's got to be, 6 feet tall. He's got to make over 6 figures a year. And he's got to have a 6-pack. Have you ever heard of a woman, let's say somebody like Brad Pitt or George Clooney? I can't think of anybody because I'm kind of older, but women don't Google men's height when the guy's a goddamn heartthrob. You ever think about that? Like, I want to see if he's over 6 feet tall. They normally want pictures of him, or they want to look at his girlfriend or his wife to measure themselves against that. But when somebody's attractive and rich, they don't Google his fucking height. So I think that's kind of funny. But anyway, getting back to our regular scheduled programming. No, I do not have a short man's complex. I'm very happy with my height. Here are 4 recommendations that you can look at that are safe if you don't want to be in the stock market. The first one is a certificate of deposit, a very popular choice among investors. CDs are very liquid. They're very safe. The only caveat to them is that if you lock them up for 6 months or 12 months and you need to get into them before they mature, you do have to pay a small penalty to your financial institution. The second one is T-bills, my favorite. These are basically backed by the United States government. They are shorter in duration. Typically, they mature less than a year. You may have heard something called like bonds or T-bonds. Those are more long-term treasuries, ideally 20 and 30 years, but specifically for this article purposes, T-bill is an investment option for less than a year. So I'm going to explain this once again for those who are new to the show about how to calculate your interest on some of these offerings, because it can be very confusing. So if you see a T-bill or a CD rate that's offering you 5% for 1 year, or let's say a T-bill specifically, since I'm on T-bills for 5% for 1 month, you're not going to get that full 5% in 1 month. That 5% has a stipulation of if you reinvest a certain amount of money over a 12-month period, you're going to get a 5% return on your money. So the 5%, you divide that by 12, and that's 0.00416 or something like that. And if you're investing $10,000 every month, you're getting that 0.00416% return on that $10,000, which comes out to roughly around, I don't know, $43 or something like that. And when you multiply that times 12, you get to $500, which is 5% of 10,000. So that's how you calculate to 5%. So don't be misled or think it's false advertising when you see a 3-month CD paying you 8%. You have to take whatever that interest rate that they're guaranteed they're going to give you and then chop that up and prorate it based on a 12-month return, because those interest rates are expressed in annual percentage rates. And then look at that monthly rate and then multiply that times the number of months you're going to be invested in. And that's how you arrive at your rate of return. The next one is called Basecamp Alpine Notes. Not too familiar with them. They are advertising a 9% over 3-month terms. Same thing, use the same math. You take that 9%, you chop it up into monthly interest rates, and then you multiply that times 3 months. And whatever the amount of money that you're investing, that's what you're going to get. They're guaranteeing that the minimum investment that you need is only $1,000. They do have a solid return. They've never failed to miss a payment, but you have to do your own due diligence. This is not financial advice. Last but not least is something called City Funds Yield. City Funds Yield Fund. I'm not a big advocate of this particular way of investing, even though they are offering a higher rate of return, as this article says, than CDs and T-bills. What I don't like about this particular investment is that it's tied to cash flow as it relates to real estate assets. And it says it right here. Funds provide investors with stable cash flow backed by real estate assets. So in aggregate, I think real estate's a little bit frothy. We all know that individual markets are still doing well, but to invest in a fund in aggregate that's tied to the real estate market, I would be more comfortable doing a CD or a T-bill. One last point before we slide over to the historical chart, ladies and gentlemen, is that I would like to bring out a point. This is not tax advice, but one big difference between a CD and a T-bill is that a CD is subjected to state tax. So if you're in a state that has a state tax, whatever return that you get on your investment, you're going to get hit with federal taxes and state taxes. If you are only investing in T-bills, T-bills are only subjected to federal taxes, regardless if you have a state tax or not. So if one rate of return is somewhat closer or just as close as the other, 9 out of 10 times, you're probably better off with the T-bills, because the certificate of deposit, it's probably on average not going to be able to offer you such a high rate to compensate for possible state taxes, if that applies to you. So just wanted to use that example so you understand that. So try to figure out what to do and when to do it. Finally, last but not least, we're going to slide over here and look at this 100-year chart of the stock market, and we're going to talk about this and why I think it can easily be to 2035 before some of us who get greedy get our money back. So as I said, this is a 100-year chart going back. We're going to start from left to right, and we're going to start off during the Great Depression around 1930. As you can see right here, the stock market was at $6,300 and it dropped. So if you bought the stock market at the height, how long before you got your money back? From 1929, I think it was to like 1958 or something like that, or 59 roughly. So roughly it took about 30 years, which is also what also is alarming about this gap is that I haven't factored in inflation. Historically speaking, I think maybe going back as 1970, so this may not apply to the Depression, but historically speaking, inflation at least since 1970, averages 3.8%. So even if you scale that down and take it at 3.5%, just imagine compounding inflation over a 30-year period. It would take much longer than May of 1959 to get your money back if you bought into the height of the stock market just before it crashed in 1929. That could easily be another 10 years. So now you're looking at 40 years to get your money back. As you can see here, during the 1970s, we had a lot of inflation. I think the type of inflation that we're going to experience in the latter part of this decade is going to be somewhat akin to the volatility of inflation that we experienced in the 1970s. I think we're going to have some periods where it goes down and it goes up, it goes down and it goes up. and it goes down and it goes up. And I think we're going to see that. I don't think we're going to see a systemic long period of time where inflation is just at 2% or below. I don't think we're going to get below 2% unless they're fudging the numbers again. So let's go up to 2000. Everybody remembers the dot-com bubble party like it's 1999. As you can see here by the graph, it was 20,000 just before the dot-com bubble of 2000. And how long did it take to get that 20,000 back? 2007. That took 7 years. Then right after that, we went into what? The great financial recession, right? That's when the whole real estate market imploded. Liquidity dried up. I think George Bush was the president at that point in time. They had to interject quantitative easing. Capitalism / liquidity was drying up. Capitalism as we know it in American society was over unless they intervene and start pumping the system with quantitative easing. If you think I'm being hyperbolic, go back and do your own research. So this problem that happened in 2008, 2009 was never fixed. They just pumped the system with steroids. And pretty soon, as you know with bodybuilders, once they get off steroids, their body looks 360 degrees different, totally different than when they're on the juice. That's what's getting ready to happen to us. So as you can see here from left to right, higher, higher, higher. Yes, the stock market is continuing to go on up. Even if we go up a little bit higher, I don't think the Dow Jones Industrial Average will see a new high in 2024. I don't think the NASDAQ will see a new high in 2024. I did also include the S&P, but I want to revise it at this point in time because the data and my technical analysis do suggest that we could see an all-time high with the S&P before the end of the year, before it starts to spiral out of control. But having said all that, getting back to the Dow Jones Industrial Average, I think worst case scenario, by the first quarter of 2025, we will be in a serious downturn in the stock market. Once again, I do not see us getting an all-time high. And even if this thing comes down half as much as it did during the great financial crisis, when you factor in, we're in the we're in the mother of all consumer bubbles. When you start talking about car loans, credit cards, household debt, student loan debt, the unemployment rate's going to go up. Everybody knows about the SOM rule. Within the last 12 months, the unemployment rate has risen higher than 0.05% or 0.5%, whatever that number is. That has always predicted 100% of the time of a recession. So unemployment over the next couple of years is going to double. In my humble opinion, this is not financial advice. So with that, with all-time consumer debt, and something that wasn't fixed back in 2008, I think you can make a very plausible argument starting in 2025 that whatever high we've seen in 2024, it's not coming back for 10 years. And then if we also have in concert with that a lot of up and down inflation, and inflation might turn out to be close to 4%, if not higher, for the remainder of this decade. And when you put all of that, that's just a recipe for disaster. It's going to continue to choke wealth from the middle class, and you're going to continue to get this K-shape of the have and have not. So there is no easy solution, and this is why some of you guys who follow me on Facebook, I am very agnostic when it comes to politics. I've got a really good friend, a supervisor at work, and we chop it up friendly, you know, and he's got a position and I have a position. I just think both are full of crap. So the analogy I like to tell people, let's say, you know, the Biden / Harris camp has 3 pillars, and you believe in Trump being able to turn things around, and he's got 6 pillars. If I'm throwing you out of an airplane, which one is going to cushion your fall more? Doesn't really matter. I think it's inevitable. You know, you get, like I've said about this, ladies and gentlemen, before, you've got all this transgender stuff that's going into our schools, not to throw shade on that particular people, but I don't think that should be ingratiated to somebody that's 4, 5, and 6 years old. That's what I'm getting at from that standpoint. So you got all of that. You've got no civility. People don't, I mean, there's just so much hatred. The moral fabric of our society is deteriorating here and abroad. And I don't think whoever you put in a resolute desk is going to make a difference, whether it's Republican or different. I think we have so many systemic problems, not to mention this debt crisis I just went over with you guys in this video, I don't think one person is going to solve that. Obama spent a lot of money. Hell, Trump spent a lot of money. Biden is spending a lot of money. We have a debt crisis in the United States, and it's at a point of no return. We're going to have to embrace or come to reality of financial austerity. And I think this country is not willing to do that. I don't think the politicians have the guts to do it. And as a result, more than likely, QE will probably continue, and we will continue to deal with high inflation. So get used to that. It's not going away. Once again, if you are within 3 to 5 years from retirement, not giving you financial advice, but a prudent thing to do may be to keep your money liquid and keep safe returns. Even if inflation starts to spiral out of control a little bit, you just don't want to be in a situation where you lose too much of your principal just when you're getting ready to retire. So that's going to do it for the Kevin Strong Show. Once again, if you enjoyed this content, please do me the honor by hitting the like button. Think about subscribing to the channel. I will leave a link into the article. So if you want to do your own due diligence about those 4 options, safe, so-called quote unquote safe options to invest your money, if you're not interested in the stock market, I'll make that available to you. Thank you for hanging with me. Make it a great day, and I'll see you in the next one.